Right here. This candle. Watch it. Price is falling, hard and fast. Everyone on retail is selling. The chart looks broken. Then it touches one specific zone, one area you could have drawn an hour earlier, and it stops dead, reverses, runs 200 pips the other way. That zone wasn't luck. It wasn't support. It was an order block. The single footprint that banks and institutions leave on every chart. The exact price they bought from. And once you can see it, you will never look at a chart the same way again. In the next 12 minutes, I'm going to show you what an order block actually is, why price obeys it, and the exact filter that separates a real one from the fake zones that keep getting you stopped out. Quick thing before we start, this channel does one thing. We take apart the mechanics behind every candle. No hype, no signals, no Discord drama. If that's what you've been looking for, subscribe right now, because the next 2 minutes are going to rewire how you see entries. Let's get into it. Here's what most traders believe. They think an order block is just support and resistance with a fancy new name. Draw a box, wait for a bounce, done. That is exactly why their boxes fail. An order block is not a level. It's a story about who is trapped and who is in control. When a bank wants to buy $100 million of something, it has a problem. There aren't enough sellers at the current price. If it just starts buying, it pushes price up against itself and gets a terrible fill. So it does the opposite of what you'd expect. It sells first. It drives price down into a pocket where retail stop losses are stacked, triggers a flood of selling, and quietly absorbs all of it. Buying everything that retail is panic selling. That final down candle, the one right before price explodes higher, that candle is the order block. It marks the exact price where the institution loaded its position. And here's the part that matters. They could not fill their entire position in one go. There are leftover orders sitting at that price. So when price drifts back down to that candle later, those remaining orders fire and price launches again. That's not magic. That's unfinished business. So we're not drawing support. We're marking the scene of the crime and waiting for the criminal to come back. Section 1. What an order block actually looks like. Strip away the jargon. A bullish order block, the kind you buy from, is the last down candle before a strong move up. That's it. The final red candle before price rips higher. A bearish order block, the kind you sell from, is the last up candle before a strong move down. The final green candle before the drop. Why the opposite color? Because that last candle is the institution's footprint, the last bit of selling before they flip the entire market upward. You're not buying the green candles everyone sees. You're buying the red one they left behind. Now, how do you draw it? Take that candle. Mark the open and the close. The body. For the highest probability version, your zone runs from the open of the candle to the high of its wick. The body is the core. The wick is the buffer. But here's a sharper tool, the mean threshold. That's the 50% line of the order block candle, dead center between its open and its close. Price very often taps that midpoint and reverses to the tick. If I had to pick one line to put my entry on, it's the mean threshold, not the edge of the box. Watch this. Price comes back down, taps the upper edge of the block, wicks into the body, touches the mean threshold, and reverses. Every order left in that zone just got filled, including, if you did this right, yours. One candle. Open, close, midpoint. That's the anatomy. But knowing what it looks like is useless if you can't tell a real order block from the 50 fake ones on every chart. That filter's coming. First, you need to understand why price obeys this zone at all. Section 2. Why does price actually respect an order block? Because if you don't understand the why, you'll trust boxes that were never going to hold. 3 forces stack at a real order block. First, unfilled orders. We said it. The institution couldn't get its whole position filled at once. The remainder sits there like a limit order waiting. Price returns. Those orders execute. The move continues. Second, liquidity underneath. A real order block almost always forms right after price sweeps a low. It runs the stops below an obvious swing point. That sweep is how the institution got the volume to fill. So underneath a good bullish order block, you'll see a liquidity grab. No sweep, no fuel, weaker block. Third, Displacement. After the order block forms, price doesn't drift away politely, it explodes. One or two big-bodied candles that tear away from the zone and usually leave a gap behind them. A fair value gap. That violence is the signature of real institutional money. A zone that price wandered away from slowly is not an order block, it's just a candle. So the mechanism, in order. Sweep the liquidity. Fill the position on the order block candle. Displace away with force. Leave orders behind. Return later to finish the job. Sweep, block, displace, return. Burn that sequence into your memory because that is the entire model on one line. If that sequence just made something click for you, do me a favor and hit subscribe. It genuinely decides whether videos like this keep getting made, and it means the next breakdown lands on your homepage instead of disappearing. And drop a comment with the pair you trade most. I'm reading them. Section 3. The filter. This is the part nobody teaches, and it's exactly why your zones keep failing. Most traders draw an order block on every single candle before a move. Then they wonder why half of them blow straight through. A real high-probability order block has to pass 4 checks. Miss one and your odds drop fast? Check 1. Did it sweep liquidity? Before the order block formed, did price run a clear high or low and grab stops? If yes, the fuel is there. If the block formed in the middle of nowhere with no liquidity taken, skip it. Check 2. Did it cause a break of structure? After the order block, price should break the most recent swing point. It has to close beyond it, not just wick through. That break confirms the character of the market actually changed. No structure break, no trade. Check 3. Is it still unmitigated? An order block is only loaded once. The first time price returns and taps it, those orders fill. That's the trade. If price has already come back and tapped this zone before, it's mitigated. It's spent. You want a fresh, untouched block. Virgin zones only. Check 4. Is it in the right place? Discount or premium? Take the full swing, top to bottom, and cut it in half. For a buy, your order block should sit in the lower half. The discount, you want to buy cheap. If your bullish block is sitting in the upper half, in premium, you're buying expensive. And your risk reward is garbage even if the trade works. Sweep, break of structure, unmitigated, discount or premium. 4 checks. Run every single zone through them before you risk a cent. The boxes that pass all 4 are the ones that look like magic on the replay. That filter alone will cut your bad trades in half. But the entry itself, exactly where you click buy, where the stop goes, where you take profit, that's its own skill. That's next. Section 4, the entry. Let's turn this into an actual trade you could place tomorrow. This is a multi-timeframe game. You find the order block on a higher time frame. The 1 hour, the 4 hour, that's where institutional zones actually live. Then you drop down to a lower time frame. The 5 minute, the 1 minute. For a precise low-risk entry, higher time frame for the zone, lower time frame for the trigger. Step 1. On the higher time frame, mark a bullish order block that passed all 4 checks. Sweep below, break of structure up, unmitigated, sitting in discount. Step 2. Wait. Do not set a blind limit order at the edge and walk away. Let price come to the zone on its own time. Patience is the entire edge here. Step 3. When price taps the zone, ideally the mean threshold, that 50% line, drop to your lower time frame and wait for confirmation. What you want to see is a smaller version of the same story. A little liquidity sweep, then a break of structure to the upside on the small time frame. That's price telling you the orders are firing right now. Step 4, enter on that confirmation. Your stop goes just below the order block, below the wick, below the swept low. Not in the middle of the zone where noise will tag it, below the whole thing. Step 5, targets. Your first target is the most recent swing high. The liquidity resting above, that alone is often 2 or 3 to 1. If momentum is strong, hold a runner for the next major high beyond it. Some of these pay 5, 6, 8 times your risk because you got in at the literal origin of the move. That's the model. Higher time frame block, lower time frame trigger, stop below the zone, target the liquidity above. Clean, repeatable, and brutal, on your old habit of chasing green candles. One more, because this is the question you'll have the second you start trading these. What happens when an order block fails? Sometimes price returns to a bullish order block, and instead of bouncing, it slices straight through and closes below. The beginner reaction is, the concept is broken, throw it out. Wrong. A failed order block becomes one of the most powerful zones on the entire chart. It's called a breaker block. Here's the logic. A bullish order block fails. Price blows through it and drops. Everyone who bought that zone is now trapped long underwater, praying for break-even. When price rallies back up to that same zone, all those trapped traders dump their positions right at break-even just to escape. That wave of selling turns the old support into fresh resistance. The block flipped. Same candle, opposite job. So a failed bullish order block becomes a bearish breaker, a short zone. A failed bearish order block becomes a bullish breaker, a long zone. You don't lose the level when it breaks. You flip it, and you trade the trapped traders trying to get out. Let's lock it in. An order block is the last opposite-colored candle before an explosive move. The exact price an institution filled its position. It works because of three things: unfinished orders waiting in the zone, liquidity swept underneath to fuel it, and displacement away from it that proves real money was there. You validate it with 4 checks. Did it sweep liquidity? Did it break structure? Is it still unmitigated? Is it in discount or premium? You trade it across 2 time frames. Mark the zone up high, wait, confirm down low, stop below the block, target the liquidity above. And when one fails, you don't delete it. You flip it into a breaker, and you trade the other side. Here's the shift. You stop drawing support and resistance lines that everyone else can see. You start marking the actual footprints institutions leave behind, and you wait for them to come back to the scene. If this unlocks something for you, the next mechanic to learn is the fair value gap, the imbalance that order blocks leave behind, and the most precise entry in the entire Smart Money Toolkit. It's the perfect next step, and it's going up on this channel next. Subscribe so it finds you when it drops, and drop a comment with the cleanest order block you find on your charts this week. I read every single one. See you in the next video.